This is Jim Connell, and I want to thank you for joining us for the LifeMax Web Conference. I'll be your presenter today, and I appreciate you taking part of your day to join us. Before we get started, let's take a little time to go through some housekeeping. If you're having any trouble logging on to the web presentation, you can first try by clicking on Join the Webinar button in your confirmation email. You will be prompted to accept the download. Click Yes or Grant, and then the download should begin. If it prompts you again to save or run, click Run. If you're still having trouble, give us a call at 800-441-0494, and we can try and help you from here. The schedule for this afternoon is to cover our LifeMax system and how you can use it to develop more business in these crazy financial times. That should take about 35 to 40 minutes, and then we'll open it up for about 10 minutes at the end for you to ask questions. On the upper left-hand corner of your control panel, there's a little toolbar with 3 buttons. At the bottom of that toolbar is a gold hand with a green arrow. At the end, when we open it up for questions, you'll just click on that to ask a question, and I'll unmute your line. Because of the large number of people on the call today, I do have your lines muted. In the center of that toolbar is a button to toggle full screen on and off. And finally, at the top are 2 little black arrows to collapse or open your control panel. That'll help you move the control panel over to the side. Okay, let's get started here. What we're going to talk about today is our LifeMax service. And as everyone knows who's been in the industry for a while, or probably even if you've been in the business for a month, every crisis leads to opportunity. When there's crisis, what are people looking for? Usually for certainty. But unfortunately, when there's crisis, what do most people do, including many advisors? Nothing. Unfortunately, I talk to advisors and brokers all the time that are hiding under their desk, not sure which way they should go with their clients, not sure whether or not they should even talk to their clients. We believe that if we can offer solutions, offer certainty, and then take action, that we can capitalize not just on the crisis, but on the opportunity that it brings to us. So the question is, what if there were a service that you could offer to virtually everyone you come in contact with that would result in new business 7 out of 10 times? Well, there is. It's our LifeMax Life Insurance Review Program. And our system is a service that we provide to you that you can provide to your clients and to your prospects. Before we get specifically into the service, though, I want to talk a little bit about what's happened and what's brought us to this point. Non-guaranteed cash value life insurance policies issued since 1980 are performing poorly, and many are at or near lapse. This shouldn't be news to most of us on the call today. The problem is that many of these older policies, these non-guaranteed policies, and I'm talking about universal life, variable universal life, whole life policies with term riders, and any other insurance policy, life insurance policy, that has a non-guaranteed component that is driven by cash value and interest rates. Those policies, many of them were issued and illustrated when interest rates were 10 to 14%. The problem is that at 14%, it takes a lot less premium to have a policy carry out to age 95 than it does at 4%. So as we're getting into these times where interest rates have stayed at 4% for very long periods of time, the cash values have not grown large enough to cover the cost of insurance as our insureds get older. A lot of these policies were issued at or near minimum premium, and with the steadily declining interest rates, we're seeing that a lot of these policies are beginning to lapse. The other thing that affects it is the growing cost of insurance in the policy as the insured ages. Well, those costs of insurance are based on mortality tables that are 20, 30, and in some cases 40 years old that are nowhere near as favorable as mortality tables today. And variable life policies certainly have suffered from long periods of turbulent markets. Most policies were never designed to suffer 2 or 3 market declines in a short period of time. And for those of you who have been in the business for 10 years, we know that, yeah, we had a strong period of time in the late 90s, but since 2000, we've had 2 major declines that are taking their toll on variable life policies. If for no other reason than looking at price, term insurance premiums have dropped nearly 75% during the past 15 years. So simply put, many policies that were purchased 15 years ago, they're overpriced and worth taking a look at. One of the things we hear a lot in dealing with CPAs and other financial advisors, over the years I've spoken to literally hundreds of CPAs, and at some point during our conversation, each of those CPAs has impressed upon me that many of their clients have not reviewed their life insurance policies in years, because every time their agent said he was coming out to review the policy, he just tried to sell them more insurance. Now, whether or not that's true really doesn't matter, because that's the perception that the general public has of insurance agents. The end result is most people have not reviewed their policies. So not only are they having all these problems that are taking place with the policies, but the policyholders aren't aware of it. The next point here is that if you are in a state where you have replacement rules that regulate how you have to propose to a client a replacement of an old policy, you're aware that there's a lot of things that can discourage you from replacing a policy. But it really goes beyond those regulations. Insurance companies discourage the replacement of old, poor-performing policies. Well, what does that mean? If I sold a New England policy back in 1988, or any company's policy back in 1988 that wasn't guaranteed, today my carrier has a new policy that's guaranteed that can be used to replace that old policy, probably for about the same premium. The difference is that old policy is lapsing. The new policy is guaranteed for the rest of the policyholder's life. Well, why wouldn't the insurance company encourage you to go out and replace that policy? Well, the reality is that insurance companies, it's built into their pricing that a certain number of policies are going to lapse. The ideal scenario for an insurance company is that if they collect premiums for 20 years and then the policyholder cancels that policy or allows it to lapse, they don't have to pay a claim. They don't have to pay that death benefit. So they have just profited by having all of that premium money coming in for the last 20 years, which they in turn were able to invest. So not only are people not reviewing their policies, but there's a lot of disincentive being given by the insurance companies to go out and look at those old policies. When we started this back in the early 90s, the reason was that the Uniform Prudent Investor Act had just come on the scene, and most states were adopting it. And at the time, it was primarily to give trustees a guidebook to follow as to what they were responsible for. And what happened was that at the time, interest rates had gone from 14% to 10%, and then 10% down to 8% on life insurance policies. And banks were discovering that they didn't have a process in place to evaluate those trust-owned policies that they had within their trust. So what we did is we started to work with them to really identify what was it that they needed to look at. Well, the Uniform Prudent Investor Act shifted the focus from the merits of the specific insurance policy to the process of identifying whether or not the policy meets the beneficiary needs and the trust purposes. Well, what does that mean? Well, essentially what it means is that a trust could own a $1 million whole life policy, and as long as that premium is being paid, that policy is probably performing okay. Maybe not up to the illustrated values based on a 10% dividend rate, but it's guaranteed to remain in force as long as they pay their premiums. But what the question is for the trustee is, I've got a $1 million whole life policy with $700,000 of cash in it. Would that $700,000 of cash be better suited in a no-lapse guaranteed universal life policy that provides $2 million or $2.5 million of death benefit. And the problem is there isn't a right answer, but it is something that has to be considered. Ultimately, that whole life policy may grow to $2 or $2.5 million, but would the trust and its beneficiaries be better suited having that greater death benefit today? Again, there is no right or wrong answer, but it's something that a trustee has to address and take on with the beneficiaries of the trust. Industry averages state that 90% of life insurance policies currently managed by trust companies are at risk for being unsuitable to the purpose of the trust, unreasonably priced, and or underfunded. Now, I've had a lot of advisors and a lot of brokers challenge that statistic. This is not about whether or not the policy that was sold 10 years ago was appropriate at the time. This is about the fact that we've had a booming stock market in the late 90s. We've had a stock market drop in the early part of this century between 2001 and 2003. We had a stock market that boomed again for 3 or 4 years, and then we had an unprecedented decline last fall in the stock market. All of those things not only affect the insurance policies, they also affect your clients' financial plans. So what this is stating is that many policies are unsuitable simply because the needs of the client have changed. And I would venture to guess that it's probably closer to 100%, not just 90%. As we look at what we can do about it, we developed a process. And our process was based on having a systematic approach to review any and all enforced life insurance policies. The advantage of providing a formal life insurance review was that we could offer this service to brokers, advisors, professional advisors, CPAs, and attorneys where you have an existing relationship with a client. You can consult with your client in a non-threatening manner. Discuss with them what's at risk. Well, the risk is your client could lose their policy and they might not be aware of it. Or if they're looking to accumulate cash value, they could lose their cash value. Or they may simply just be overpaying for their existing policy. The benefits of a review, if done early enough, are that the clients can make changes to improve their current coverage, or they can evaluate better, lower-cost alternatives and possibly even leverage existing cash values to provide greater benefits. As an advisor, you have the opportunity to create a profitable value-added service for your business and individual clients. It may be something you bill for. It may be something that you're paid a commission on. The idea here is that you have the opportunity to improve your client's financial situation and gain another piece of their financial plan. And in the meantime, you can also protect yourself from possible lawsuits for not providing adequate financial advice. Well, advisors tell me all the time, well, I'm a property and casualty agency, or I'm an annuity broker, I'm a financial planner. My client knows that I don't advise them on their life insurance policy. Well, you know what? Your client may know that you don't advise them, but it's the beneficiaries you have to worry about. When your client dies and their policy lapsed prematurely, it's the beneficiaries that you may have to answer to. And they may not be aware that you didn't provide that financial advice. So this is the reason for the LifeMax review. This is the reason for the service we provide. And a lot of you are probably also asking the question, isn't this what life insurance agents already do? Unfortunately, the reality is that many life insurance agents don't do this. As we looked at that first slide earlier, one of the greatest fears that clients have when a life insurance agent calls them up to review their policy is that the agent just shows up and tries to sell them more life insurance. That fear is real because that's what many agents do. So what we're doing is bringing to the table a process that we go through to actually evaluate the policy that your client owns. This is really what sets us apart from what everyone else is doing. Up in the green boxes across the top, if you have a client that has a life insurance policy and you can find out the carrier name, the policy number, and gather some real basic personal data about your client, have them sign an authorization letter, if you send that to us, We take that and go out to the carriers, and then we go down on the bottom left-hand side of your screen, and the first thing we do is put together a policy summary for the client. We look at the policy type. If your client has a whole life policy, they probably think they own term insurance. If they have term, they think they own whole life, and if they own universal life or variable universal life, they have no idea what they own. We look at the death benefit. We look at the planned premium. Why is the planned premium important? Well, this isn't about fixing blame for policies that are falling apart, but the reality is that if it's a universal life or a variable universal life policy, at some point during that client interview, the agent said to the client, "Mr. Client, this is a flexible premium policy, and that means that you don't have to pay the premium every year." Well, guess what? The client didn't pay the premium every year. So not only have interest rates gone from 14% to 4%, but the client didn't even pay the premium that they were expected to pay. We look at the owner of the policy. We look at the beneficiary. And the beneficiary, this alone is worth the time that we spend on the review. We get policies in where the beneficiary is a wife from 3 marriages ago that shouldn't be the beneficiary. We have business partners from a business that hasn't been in business for 5 years. We have beneficiary designations that are banks for loans that have been paid off for 15 years where they should have been collaterally assigned. All of these things need to be addressed, and all of these things are important. We have had policies come in where there have been child term riders on a 72-year-old client's policy. Their children are in their late 40s or 50s. Not a big deal, but why pay for something that you're never going to use? We also look at whether or not the policy is currently offered for new issue. Sometimes poor performance just has to do with the older generation policies, and what your client really needs is to get into a policy that's more modern. As we move across this screen from left to right, if it's term insurance, we look at the duration of the policy, we look at the guarantees, and we look at the conversion options. Is your policy convertible? Well, you know what? It's possible when the client bought the policy that they heard that word convertible, but they don't know what that means. Many agents don't know what that means. A client may be sitting there with a term policy that's in its 18th year, and they're looking at it thinking, gee, I had a heart attack last year, I can't get new insurance, and I'm going to lose my 20-year term the year after next. They don't know that they may be able to convert their policy to a permanent policy without any underwriting. Is the policy renewable? Depending on the state that the policy was bought in, most policies are renewable even beyond the level term premium. It's expensive, but they're renewable. But some states had 20-year term policies that were issued, and at the end of 20 years, they're done. As we move down, this is really one of the keys to what we're doing. If it's a cash value policy, we're going to look at the current values. We're going to look at the future values. What is being projected? It's those projected values that 90% of the time drive whether or not your client's policy is going to remain in force. We look at loan provisions, loan values. Well, why is that important? Many corporate-owned policies were bought for the purpose of funding deferred compensation payouts. Those loan provisions are going to determine how much money they can take out of that policy. We look at the death benefit. Is it guaranteed or is it just projected? We look at various cash flow scenarios. After we do that, we're able to give the client a report of exactly how their current policy is performing and what it is they own. Chances are pretty good that's something they've never had before. As we move over to the center column, policy comparison, this should probably be flip-flopped. The bottom box says, is the policy meeting the stated purpose? This is really the key. Now that we know how the policy is performing, is it meeting the purpose that the client has stated? We look 30 and 40 and 50 years down the road when we do projections. Our clients' needs and their desires change every 3 to 5 years. So we never really know whether or not the policy is meeting the stated purpose. Is it income replacement, debt reduction, or cash accumulation? We then look at alternative products and what's available today in the industry. What are similar products on the market that may be more affordable, that may suit their purpose better? So this is where we get into providing alternatives if need be. And then finally, all the way over to the right, we look at additional data. Number one, carrier financial strength, carrier ratings. A year ago, maybe a little longer than a year ago, we laughed at this. All carriers were $250 billion to $500 billion to $1 trillion in assets, or at least they were a subsidiary of a company that was. What could possibly happen to a company that big? Well, I think we've all learned that it can happen regardless of how big the carrier is. We then take a look at life insurance guides. If the client needs to be educated about life insurance and what it is they should have, we can provide additional information on that. And then optional services. If you're not already reviewing their goals and showing them what they should have versus what they do have, then we can do that as well. But it's this process here that separates us from what we're doing, from what everyone else is doing. And we believe that this process is what creates the value in the LifeMax system. Let's take a look at a sample. This one page, this is a summary of a client's in-force illustration. We literally took a 17-page illustration from a carrier, summarized it on, in this case, unfortunately for this gentleman, on one page, but usually we can fit this right on 1 or 2 pages. We put text boxes on to clarify what's being presented so that there's no guessing as to what the client has. As we blow this up, you can see over on the left, based on policy guarantees and continued premium payments, your policy will lapse or run out in 5 years. Pretty straightforward. Assuming current interest rates, cost of insurance, your policy will lapse or run out in 9 years. The only question we usually get from a client, well, which is it? Well, Mr. Client, unfortunately, it's probably somewhere between the two. You're going to lose your policy without making some changes to it. This man happened to be 73 years old, told us he was in excellent health, and he also told us, my only goal for this policy is to have this death benefit be in place when I die. So I want this to last for the rest of my life. So the next thing we do in this case is we look at alternative products. We're looking only at guarantees on this page here. Well, why only guarantees? Well, the client's seen what happens with projected values that aren't guaranteed. They don't hold up. So now he wants to know what is guaranteed and what can I get that I don't have to worry about this going forward. What else is available? And again, we put all of this on just 1 or 2 pages. And as we blow this up, over to the left-hand side in the dark gray, that's his current plan. In the center, alternative number 1, that's the proposed plan where he takes his cash values from his current policy, moves them by 1035 exchange to a new policy, and at standard rates pays just $34 more per year than what he had been paying for 20 years, but now he's got a policy that's guaranteed for the rest of his life. Alternative 2, back in 2004, that happened to be the next closest competitor. Today we've probably got a dozen competitors within a couple dollars of Alternative 1. This man actually qualified for super preferred rates, ended up paying $1,100 per year for $110,000 of death benefit guaranteed to age 120. The result? The client received an understandable summary of exactly what they own, what's guaranteed, and what's projected to happen in the future. And the client is able to determine how their plan stacks up against alternatives that are available, and now has the information necessary to determine if their plan is the most appropriate plan for their needs. That's what LifeMax is about, giving the client something that they've probably never had before, an understandable summary of what they own, what's projected to happen in the future, and what alternatives are available to them. Why is this so important? This is kind of difficult to read, but this was faxed to us. This is the back page of an insurance company annual report that was sent to a client. And in the yellow there, again, I know it's hard to read, but it says if you continue to pay your planned premium of $80 quarterly and no additional loans, withdrawals, or any policy changes are made, under guaranteed assumptions, your policy will not lapse this year. Under current assumptions, your policy will not lapse this year. Well, what do you think the client is taking from this when they get their annual report? Well, they're probably assuming I pay my premium, I have my coverage. It's not going to lapse this year. They're not thinking that, gee, I should request an in-force illustration so that I can find out that my policy may not lapse this year, but it is going to lapse in 3 years. This is what we got from the carrier after he signed an authorization and had us go out and get an in-force illustration. So the annual report, all it was telling him is that your policy is not going to lapse this year, but provided nothing for him to determine whether or not he was going to have that policy in the future. This is why the LifeMax reviews are so important. Some of the things that come about from this aren't always what you expect. In this case, a CPA sends a policy over to us to review, and he tells us down in the red box there, the policy has $7,000 of cash, and this policy is going to lapse without substantial premium increases. The CPA tells the client, take your $7,000 and run. You can't afford the $40,000 per year that it's going to take to keep this policy going. But we looked at it and said, gee, this guy's paid in $119,000 to his policy. What can we do that we can help him out? Well, the insurance carrier looked at it and said, hey, not only are we going to give you a projection, but we're going to show you what he actually did in the past. He was told back in 1985 when he purchased this policy that if he paid $12,300 per year at 13.9% interest, he was going to have $500 million of cash in his policy at age 65. The problem is not only did interest rates go from 13.95% to 4%, but he never paid the $12,300. He only paid the minimum requirement premium. So we added that up and said, all right, he's paid in $119,000. In the insurance world, we have Code Section 1035. And Section 1035 allows us to make tax-free transfers from annuity to annuity, life policy to life policy, and also from life policy to an annuity. Well, what happens when we do a 1035 exchange? What happens is, in this case, his $7,000 of surrender value goes over to the new annuity. But in addition to that, his cost basis from the life insurance policy also goes over to that new annuity. So we told him, put your $7,000 in an annuity, you'll have $119,000 of cost basis, and every dollar of interest on that $7,000 will be income tax free until you return your entire cost basis. Well, the client looked at us and said, you know what? He said, that'll take me 400 years to recover my cost basis. He then told us up on the right-hand corner, I've got $200,000 of non-qualified money in a CD at the bank. What if I add that to it? Well, absolutely. And down in the bottom left-hand corner, the $7,000 from the life policy, $200,000 from the CD, gave him a cash value of $207,000, $319,000 of cost basis, which is $119 from his life policy, and $200 from the CD. The first $111,000 of growth is income tax-free, being offset by any unused cost basis. This is something that most clients, most brokers, and most CPAs have never seen before. Now, does this mean that you're going to run out and find a whole bunch of policies with $119,000 of cost basis? Probably not. But there's thousands of policies out there that have $20,000 and $30,000 and $40,000 of cost basis that your clients would otherwise just allow to lapse if they didn't know that they could use that cost basis to create tax-free income in their annuities. Okay? The next thing I want to tell you about here is our typical case. Our typical case is a client that has some term insurance, some universal life insurance, and one or both are running out. In this case, we have a 58-year-old male. He's got $530,000 of death benefit, which is made up of $430,000 of term and $100,000 of universal life. But the term insurance is going to run out at age 69. At that point, he's got only his $100,000 of universal life left, and that's projected to run out at age 76. This is what we see more often than not. In this case, what we look at is a comparison of what's guaranteed. Over on the left, that's his current scenario. That's what's running out. We can propose two things to him. First, we can match his existing death benefit. Let's take $26,000 of cash value from his policy, 1035 exchange it to a $530,000 universal life policy, pay $1,852 for 11 years, and be done. At the same time, just like what he had now with the term and universal life, at the end of the 11th year, we drop the death benefit in the universal life from $530,000 down to $100,000, and that $100,000 of universal life will stay in force for the rest of his life, guaranteed. Does that make sense? Alternative 2 says maybe he wants more than $100,000 after age 70. In this case, what we've proposed is the same $530,000, dropping it down to $200,000 now at age 70, paying $3,639 instead of for 11 years, for 12 years, but then he's done paying that going forward. Now, when we look at this, most of us can look at this and say, you know what, I think I could sell that. All right? This is what our clients are looking for. They're looking for solutions that make sense, that give them the coverage they need well into the future. They don't know they can do this unless somebody reviews their policy and tells them what they can do. Okay? Now, in this case, once again, client received an understandable summary of exactly what they own, what's guaranteed, and what's projected to happen in the future. But down at the bottom, one last bullet point. In this case, if you make the sale, you're going to get paid. This male, age 58, total compensation to the agent, $7,965. If the client happened to be 68, which we see all the time, total compensation to the agent, $13,950. All right. What did the agent tell us? The agent told us, because of your LifeMax review, I did experience the confidence of knowing our recommendations were the right thing to do, which allowed me to make one of the easiest sales in my career. What if there were a service that you could offer to virtually everyone you come in contact with that would result in new business 7 out of 10 times? What would you do? Well, I can tell you what you should be doing. With the LifeMax policy review, all you have to do is what's above the line. And I realize that that's one of the hardest parts. Finding a client with a life policy, gathering the information, having them sign an authorization letter. And then we prepare everything below the line and provide you with the completed LifeMax review. But look, we don't just send you out there and ask you to go find a policy. We're also going to provide you with the script that's not a silver bullet, but it does work based on our experience. And here's what it says, and this is important. Mr. Client, I'm just calling to let you know that we're giving each of our customers an opportunity to do a free life insurance review. I know what you're thinking. They just want to sell me more life insurance. This is not designed to sell you more life insurance. You know what? This is what your clients are thinking. When an agent calls up and offers a life insurance review, the first thing they're thinking is he wants to sell me more life insurance. So we acknowledge that. We know that that's what you're thinking. And at that point, you're breaking down the barrier just a little bit. This is not designed to sell you more life insurance, but it will give you an understandable summary of what you have and may even save you some money. The reason we're doing this is that with interest rates being so low for so long and insurance rates changing so much, a lot of people are finding that their policies are not doing what they expect them to be doing. And many of our clients tell us that they haven't reviewed their policy in years because every time their agent said he was coming out to review their policy, he just tried to sell them more insurance. At this point, your client is nodding their head. That's exactly what they're thinking, and in many cases, that's what their experience has been. Now, that doesn't mean that they're going to say, come on over, let's do a review. But this does increase the likelihood that they're going to open the door to allow you to do it. But they're going to have questions. What is a LifeMax program? We give you the answers to the questions. I already have a life agent. Well, that's okay. This program isn't designed to change that, but it will give you a clear picture of exactly what you own and how it's performing. Some people will say yes. Some people will say no. We'll give you backup, including articles that support what we're talking about, third-party information gives you credibility. And we even have a script that we developed in the past year based on what's going on. Mr. Client, with all of the bad news about insurance and financial institutions in the headline, I'm just calling to let you know that there are some steps that you can take to help you understand how this may affect you and your life insurance policies. That's what this is about, taking steps to help them understand what the impact of what's going on in the markets is having on their policies. All right, again, this is about providing a complete system. All you have to do is complete this questionnaire. Up at the top, advisor name, that's you, insured, male, female, smoker, non-smoker, date of birth, and the insured Social Security number. If the owner is someone other than the insured, we need to know the owner's tax ID number. Well, why do we need that information? You're going to see that we're going to have you sign an authorization. We take that authorization and we go to the insurance carrier, and the first thing they ask us to provide them with is the date of birth and the Social Security number of the insured, and then they ask us for the owner's tax ID number before they'll even tell us where we can fax or mail the forms. So we need to have that. We then ask, what is the purpose of the insurance? If it's death benefit, we're going to provide different alternatives than if you tell us it's cash accumulation. Provide a description of the purpose. How long will the coverage be needed? If it's 5 years and they have 5-year term, they're probably fine, but we're going to do the review to make sure that what they have is going to meet the need that they've specified. What is the health of the insured? Any significant health problems? This is not about doing underwriting, but it is about knowing in advance if a client has recently been diagnosed with cancer or any terminal illness, we're not going to show them alternatives that they could never qualify for. But we are going to work with their existing carrier to make sure that their policy stays in force as long as they do. And quite honestly, for most of us, that's where we're going to get the most referrals, is from that person that knows we went the extra mile even though we weren't getting paid for it. Okay? Next up is our authorization. This authorization gives me the ability to go out to a carrier and gather information about our clients' life insurance policies. You can customize this with your information, but if you do that, then you have to go out to the carrier. And you'll see that this is not always an easy task. It oftentimes requires many, many contacts with the carrier before we get what we're asking for. This is what we're asking for. It's very specific. This letter authorizes Jim Connell Jr. CPA to obtain information from you regarding my policies. Number one, a current policy illustration detailing all years, not summary years. We want all years. If the policy does not run to maturity at the current premium level and interest rates, please provide a policy illustration that does run to maturity at the required premium level. Well, why do we want that? Two reasons. One, if the client has to repair the policy they own, we need to know what it's going to take. But the second reason is that if we're proposing alternatives, in the client's mind, they're thinking, geez, I'm paying $2,500 per year now for my coverage. If I increase my premium to $2,700 or $3,000, I'll probably be fine, right? Well, in reality, what happens is that when a premium needs to be increased on an existing policy that's 15 or 20 years old, very often it comes in that it needs to be increased to $6,000 or $8,000, or in a case we just had, $14,000 from $3,000 to keep a policy going. So what that gives us is the tool to say to the client, if you purchase one of the alternatives that are going to cost you $3,000, it's much less expensive than repairing your existing policy that may cost you $6,000 or $8,000 or $10,000. If the policy is variable life, please run the illustration with an assumed interest rate of both 6% and 8%. And I've had brokers tell me recently, don't you think that's a little aggressive? Well, we have to start somewhere, and if we're not going to get a 6% return going forward, or we're not confident that we're going to get that, then we probably shouldn't be in a variable life policy altogether. We also ask for a current policy summary, which includes the type of the policy, the death benefit, cash values, riders, and the current beneficiary. Okay, what's next? You've gathered the information. You're now going to fax or email that completed paperwork to our office along with a recent policy statement or bill if available. Why do we ask for that? Well, sometimes a client bought a policy from Aetna, and in their mind, that's who they still have the policy with. But in reality, we know that Lincoln handles those policies now. Or it could be a small local policy company that uses a major carrier to provide administration. It just gives us the ability to more easily contact the company that actually administers their policy. We take over from this point. We begin gathering information about your client's policy or policies, and you'll receive weekly status updates via email. Once we get all the information in, we put together the review, and we go back and forth with you to develop the alternatives based on what you feel the client is looking for. Expectations. Connell Financial Group is an independent marketing organization. We get paid when you get paid. When a LifeMax review is completed and your client wants to implement an alternative, which they will probably 7 out of 10 times, we expect that those cases come through us. Now, for most cases, you do not have to switch your IMO. This does not require you to go to your existing IMO and say, hey, I'm moving. This is about looking at a system that will provide you with an alternative means to develop business with your client. Most carriers today allow you to be contracted dually with more than one IMO. There are some that don't, but we're going to work on this so that the carriers that are in your review are the carriers that you can sell, and you can sell through us. These are some of the carriers that we do business with. And as you can see when you look at it, it's pretty much every major carrier out there in the market. And the overwhelming majority of them allow us to dual contract you so you can write the business. Okay, the goal. The goal of this program has got to be to provide the policyholders with an understandable summary of their existing life insurance policy. Now, why is that so important? Most often, when an agent goes out to review a client's policy, they show up with a ledger from their current carrier in their pocket. That's not a policy review. This is more than that. We're looking to rescue failing policies, address changing needs and goals, turn old failing policies into valuable tax benefits that we showed you with the annuity 1035 exchange, and leverage existing policies into multi-use plans that offer additional benefits like long-term care benefits that were not available in some of the older policies. And guess what? You can get paid to do it. The target market for this are people who are 55 and older. Those are the people that bought policies 10, 15, 20, 30 years ago that they want to keep in force for the rest of their life. So if you want to make an extra $100,000 or more this year, all we're asking is that you give LifeMax a try. Identify 10 prospects today that you can call. Those prospects, best people to call, your clients, those people who you know own life insurance. Review our What's Happened slide. We're going to send this out to you so that you have the information. Get comfortable with the telephone script and make the calls to offer the service. The goal here is to get signed authorizations so that you can evaluate the program. Fax or email those completed forms along with that recent bill or annual report to our office and get started doing this. I have brokers who call us after the webinars all the time, and they say, look, I'm building a marketing program around this service that we offer, and I want your help. It's going to take me 6 to 8 weeks to put this program together. That's okay, but my suggestion is that you go out, find someone who you can work with on this right now so that you can evaluate the system and determine whether or not it's worthwhile to offer to your clients. All right? So with that, let me open it up for people to ask some questions. If you've got a question, remember, you can just on the bottom of your toolbar, there's that gold hand with the green arrow. Go ahead and click on that, and it'll show up here that you have a question. I'll unmute your line and allow you to ask the question. Anybody have a question? Boy, this is the first time ever that we've had no questions with a group this size. All right, then. If there's no questions, I'm going to wrap things up. Let me tell you up front what will happen from this point. You will get some follow-up emails The first one you get will come from us. It will have our LifeMax Forms Kit and a copy of today's presentation. If you want to have the presentation personalized so that you can use it with your prospects and clients with your information on it, all you need to do is email us your logo and your information that you want to go onto that presentation. Otherwise, I want to thank you for your participation today, and I look forward to working with you in the future. Thanks very much, and have a great day.